In this video, we are going to look at how to adjust your trading plan to suit other markets. Not every market is the same, and because of this, your trading plan may not be as effective when you try and scale into other markets. This is especially true when day trading on lower time frames, the 1 hour and below. What works on, say, the FTSE 100 is less likely to work on the Dow Jones without some adjustments. However, adapting your trading plan isn't always as complicated as you may think. We are going to look at a simple way to adjust your trading plan to suit the markets you want to trade. The first thing to say is that there is no secret involved with price action. It simply represents what price has been doing, and we trade the meaning and the psychology behind recent price movements and what they suggest for the market moving forward. This means that price action is fairly universal across markets, and so how we interpret it on one market is rarely different to how we read it on another. Where markets do differ is in terms of volatility. Whereas the Dow Jones regularly moves over 200 points in a day, this is less likely on the FTSE 100. So it is unlikely that a trading plan for the Dow Jones will work on the FTSE 100 without some adjustments. Again, more so on the lower timeframes. So how do we adjust our trading plan? First of all, you need your base trading plan. This is the trading plan you use on whatever market you currently trade. We then compare the market we trade to the new market. We then identify the difference and work out the adjustments we need to make. We will use the FTSE 100 as our base market. We will then work out what adjustments we need to make if we want to trade the Dow Jones and also the S&P 500. An easy way to spot that you potentially need to adjust your trading plan is to look at the market spread, which is what your broker charges you for placing a trade. What you tend to find is that the spread coincides with market volatility. The higher the spread, the more volatile the market. The lower the spread, the lower the volatility. I will be using current IG index spreads in these examples. Here we can see that the Dow Jones has a higher spread and the S&P 500 a lower spread than the FTSE 100. This suggests our trading plan may require some tweaking. The FTSE 100 has a spread of 1 point. The Dow Jones has a spread of 2 points, and the S&P 500 has a spread of 0.4 points. Okay, now let's work out the difference in terms of volatility. To do this, we use an average true range indicator. We want to set the number of periods to 180, which will give us around 6 months of data. Almost all brokers will offer an average true range indicator. We then hover over the most recent candlestick on the daily time frame to find our reading. Here we can see the FTSE 100 on the daily chart. Our average true range indicator is set to 180. We get a reading of 60.6. Here is the Dow Jones, and we get a reading of 121.6. And finally, we have the S&P 500 with a reading of 14.7. Let's round those numbers to make it slightly easier for our examples. The FTSE has an average true range of 60. The Dow Jones has an average true range of 120, and the S&P has an average true range of 15. Now let's work out the difference. The FTSE 100, our base market, has an average true range of 60. The Dow Jones reading is 2 times the FTSE 100. The S&P 500 reading is 0.25 times the FTSE 100. Now we have the data we require to move on and figure out what adjustments we need to make to our trading plan. We can then use some simple math to work out sensible adjustments. Let's say our trading plan uses these rules. 1. We enter on a 1-point break of a signal. 2. Our stop is 20 points above or below our signal. And 3. We look for on average 30 points per trade. We simply use the difference in our average true range readings to work out the changes. The FTSE 100 is our base market. For the Dow Jones, we multiply everything by 2. For the S&P 500, we multiply by 0.25. So on the Dow Jones, our entry would be a 2-point break of a signal. Our stop would be 40 points above or below our signal, and our average target would be 60 points. For the S&P 500, we would enter on a 0.3-point break of a signal. Our stop would be 5 points above or below our signal, and our average target would become 7.5 points. Okay, that was a video on how to adjust your trading plan to suit other markets. As with everything in trading, it is still always recommended to test your strategy before trading it on other markets. As always, I hope you found that useful. I'm James Orr and thank you.